As stock prices drop, people are becoming more worried about the economy. But that's not the only concern, because many jobs might be at risk soon. What does this mean for you and your family? How can you get ready for what's coming? Stay with us, because in today's video, we'll explore the warning signs of an economic downturn and how you can protect yourself. Times may be tough, but with the right information, you can get through it. By Monday, all three major US stock indexes were deep in the red. The Dow Jones Industrial Average plummeted by more than 1,000 points, while the S&P 500 and the Nasdaq both dropped over 3%, marking the S&P 500's worst one-day performance since September 2022. These sharp declines followed a particularly brutal day for Japan's Nikkei index, which saw its biggest drop since the infamous Black Monday crash of 1987, losing a staggering 12.4%. European markets didn't fare much better, as they too struggled amid the global sell-off. The steep losses reflect a growing unease among investors, especially after last week's disappointing economic reports from the US. The data revealed that only 114,000 jobs were added in July, falling short of the expected 150,000, and the unemployment rate ticked up to 4.3%, the highest it's been since October 2021. While these numbers alone don't spell disaster, unemployment is still relatively low, and the job market underperformance isn't catastrophic. They're seen as warning signs that the US economy might be starting to show some cracks. This is particularly concerning because until recently, many economists believed that the US would dodge a recession despite the economic slump caused by the pandemic. And so far, it has. However, these new reports have reignited fears that a US recession could still be on the horizon, with potentially devastating effects on the global economy. In fact, on Monday, Goldman Sachs raised the odds of a recession occurring in the next year from 15% to 25%. So how worried should we be? It's difficult to say for sure, because while the recession fears are certainly grabbing headlines, it may be too soon to hit the panic button. The US economy wasn't just expected to be in good shape, it actually is in pretty decent condition right now. There is definitely some slowing down happening, said Matt Collier, an economist at Moody's Analytics. But the core factors that have kept us optimistic about the US economy, they're still intact. In other words, where there are signs of a slowdown, the fundamentals of the US economy remain strong. The job market, though not as robust as hoped, is still adding jobs. Consumer spending, which drives much of the economy, remains solid. And businesses, despite some uncertainty, continue to invest and grow. This doesn't mean we should ignore the warning signs. The market's reaction shows that investors are jittery, and that jitteriness can sometimes become a self-fulfilling prophecy. If enough people believe a recession is coming, they might start to act in ways that make it more likely to happen, like pulling back on spending, delaying investments, or selling off stocks. But for now, it's important to keep things in perspective. The current economic situation is complex, and while the recent data has caused concern, it doesn't necessarily indicate that a recession is imminent. The US economy has proven to be resilient in the face of challenges before, and there's a good chance it will continue to weather this storm. While the recent market drops and economic reports have certainly raised some eyebrows, it's not time to panic just yet. The US economy is still on a solid ground, even if there are a few cracks showing. Investors should stay informed and cautious, but remember that markets often overreact to short-term news. The big picture still suggests that the US economy is more resilient than the recent headlines might lead you to believe. Is a recession coming? The recent rise in unemployment has many people worried. The increase triggered what's known as the Sahm rule, a guideline that suggests a recession might be near when the average unemployment rate over 3 months rises by at least half a percentage point from its lowest point in the past year. Historically, this rule has successfully predicted every US recession since 1970. However, this time around, the economist who created the rule, Claudia Sahm, isn't so sure it will be as reliable. The post-pandemic economy has been anything but typical, defying many traditional recession indicators. For instance, bond yield curves, often used to predict economic downturns, have been so erratic this year that most bond strategists no longer consider them accurate predictors of a recession. If the Sahm rule were to trigger now, it might be just one of the many indicators that aren't up to the task in this unusual economic environment. Sahm mentioned in an interview before the most recent jobs report was released. One reason the Sahm rule may not work as well in this current situation is the nature of the rise in unemployment. Instead of being driven by widespread layoffs, the increase in unemployment is actually due to more people entering the workforce. This growth in the labor supply isn't necessarily a bad sign. In fact, it could indicate a strengthening economy rather than one on the brink of a recession. According to Matt Collier, an economist at Moody's Analytics, unemployment could keep growing. But right now, the labor market isn't flashing red as much as it's slowing down. In other words, while the rise in unemployment is something to keep an eye on, it's not an immediate signal that a recession is on the way. The labor market might be cooling off, but it hasn't yet reached a point of major concern. The global market sell-off, what's behind it? The recent global market sell-off wasn't just triggered by the US jobs report. Another factor that may have contributed is what's known as carry trades. These trades involved investors borrowing money in currencies with low interest rates like the Japanese yen or Swiss francs, and using that borrowed money to invest in higher yielding assets such as US Treasury bonds. However, the yen's value has increased by 11% against the US dollar in just 1 month, making these trades less profitable. Investors might be unwinding these trades to minimize their losses, which could have contributed to the crash of Japan's Nikkei index. Instead of taking risks, many investors are now putting their money into safer assets, such as US Treasury bonds, which further impacts global markets. Goldman Sachs, one of the world's leading investment banks, has urged caution when interpreting the recent market volatility. In a recent analysis, the bank stated that while there is some risk of a recession, it remains limited. They also emphasized that they don't see any major financial imbalances that could lead to a severe downturn. Even though Goldman Sachs increased its projection for the risk of a recession, the bank believes there's still plenty of room for the Federal Reserve to step in and support the economy. The Fed, which plays a critical role in managing the US economy, is expected to cut interest rates soon, possibly as early as its September meeting or even earlier if necessary. Interest rate cuts would help ease the burden on borrowers and businesses, providing some much-needed relief. Now that inflation has come down close to the Fed's 2% target rate, Moody's Analytics is predicting that the Fed will cut rates twice before the end of the year, once in September and again in December. These cuts would gradually ease the high interest rates that have been in place to combat inflation, which could go a long way in calming the stock market. Despite the recent rise in unemployment and market jitters, there are still plenty of reasons to be optimistic about the US economy. According to Collier, households remain in good shape and businesses have continued to hire solidly, and businesses and households have handled their debt relatively well. This suggests that the US economy is more resilient than some might assume. The fact that households are managing their finances well and businesses are still hiring indicates that the economy has a solid foundation. This resilience gives the Federal Reserve more flexibility in how it manages monetary policy, allowing it to unwind its current policies slowly and carefully. The US economy has shown remarkable resilience, and with careful management from the Federal Reserve, it's likely to continue weathering the challenges ahead. Instead of panicking, it's a time for cautious optimism and a close watch on how the situation develops in the coming months. What are your views? Let us know in the comment section below, and don't forget to like, share, and subscribe to our channel.